This is our first video from Chapter 8 on consolidated returns. We're going to talk about what it takes to qualify to be able to file a consolidated return instead of separate corporate returns. If a parent subsidiary group of corporation qualifies, it may elect to file a consolidated tax return. So that's very different from what we do in financial accounting. If you qualify to file consolidated financial statements, you have to file consolidated financial statements. In the case of tax returns, if you qualify, then you can elect to file the consolidated tax return, but you don't have to if you don't want to. Once your election has been made, you cannot revoke unless the group of corporations ceases to qualify. So we'll talk about the qualifying conditions. If they are no longer true, then you can't file the consolidated tax return anymore. So that's one way to stop filing, is just cease to qualify. The other way is to get IRS permission to stop filing consolidated returns. But you can't do it if you still qualify unless you have permission. Potential advantages of consolidation are many. First of all, the losses by one member corporation may be used to offset income of another member corporation, whereas a net operating loss could reduce future taxable income. If the corporation were filing a separate return, it can actually offset the income of a profitable corporation in the same group that year. That's an advantage. Capital loss could be deducted against another member corporation's capital gain. So if a corporation has a net capital loss, that net loss can be carried forward for a little while, but that will actually expire after a while and could be lost forever. On a consolidated return, you can offset that loss against another corporation's gains if there is one. Credits by one member corporation may be used against taxes of another member corporation. Most business credits are not refundable credits. You can only use them to reduce taxes. So if your corporation with the credit also has a loss, that corporation has no taxes that the credits can be used against. On a consolidated return, the credits could be used against another corporation's taxes. Also, income from intercompany sales will be deferred. So if one corporation in the group makes a sale to another corporation in the same group, the profit from that intercompany sale is not going to be included in corporate taxable income. When we get to the computation in the next video, we will see exactly how we are going to eliminate profit from intercompany sales. There are some disadvantages of consolidation. Now, the textbook lists more than the ones I'm going to include here. Some tax ceilings may be reached sooner if they are applied on a consolidated basis. That is in the book, and it's also here. For example, the business interest deduction limitation. We talked about that a little bit earlier in the course. That is for taxpayers with average gross receipts above 30 million. So it's only for large corporations. But this is not Fortune 500 large. This is local Chamber of Commerce large, $30 million of average gross receipts. And the business interest deduction is limited for taxpayers with average gross receipts above that level. If you file a consolidated return, that level will kick in quicker because you're combining the gross receipts of all the members of the consolidated group. Also, the corporate alternative minimum tax. There is a corporate alternative minimum tax. It only applies to very large corporations. It applies to corporations with a 3-year average adjusted financial statement income of in excess of $1 billion. That is Fortune 500 size corporations now. But again, if you file a consolidated return, you're more likely to get there than if you don't. So that would be a disadvantage, the sort of thing where you hit those ceilings earlier than you otherwise would. Business interest deduction, obviously, more relevant to more corporations than the corporate AMT, but they both could be relevant depending on your particular situation. And then, of course, there's that once you elect it, you cannot unelect it without IRS permission. So those are some disadvantages that you might consider. The book also mentions you would not include intercompany profit, and that's an advantage of a consolidation. And they say, well, you would also not include an intercompany sale at a loss, which is a disadvantage. You don't get that loss. That's technically true. It is much less likely, though, that you're going to have intercompany transactions that result in a loss. It's just not the sort of thing that's going to happen very often. You're not going to be selling your inventory at a loss to another member of the consolidated group. And if you do sell it at a loss, but you're selling it to all your other customers at a profit, the IRS is going to say, no, we're not going to respect that loss that you took on that inventory because you're not selling at fair value. So therefore, we're not going to accept your numbers. So is it a disadvantage that you can't do that in a consolidation? Maybe in some circumstances, but they're very limited circumstances. So it's in the textbook. I'm not crazy about that as a disadvantage, but there are certainly some disadvantages that you may run into. Okay, so let's take a look right now. Without just that much, we can look at problem 830. Boulder Corporation owns all of the stock of Pebble Company. So Boulder's the big parent company and Pebble's the little subsidiary. Together, they constitute a federal affiliated group and a parent subsidiary controlled group. By completing the following table, delineate for Boulder's tax department some of the effects of an election to file federal consolidated income tax returns. Letter A says Pebble pays $1 million cash dividend to Boulder. We're going to look at how that looks if you file separate returns and consolidated returns. Separate returns, 100% dividend received deduction. Okay, so you get the dividend from Pebble, but immediately subtract 100% dividend received deduction, and that will not be limited by Boulder's income. So you get the 100% no matter what Boulder's income is. Consolidated, the dividend will simply be eliminated. That's not a huge difference. It's funny, all three of these don't actually amount to much of a difference between separate returns and consolidated returns. Not sure why they chose these three examples. But anyway, there it is. You get 100% dividend received deduction or you eliminate the dividend altogether. Not much difference in the bottom line there. Letter B, same situation. Boulder's tax liability is $95,000. Pebble's liability totals $75,000. Well, each company is going to pay their own. If you do a consolidation without any other information than that, total tax would be $170,000. 95 plus 75. Still $170,000 either way. Oh well, okay. Letter C, Boulder uses LIFO for its inventories. Pebble uses FIFO for its inventories. Okay, well, each company can choose their own inventory valuation method if they're filing separate, and if they file consolidated, each company can choose its inventory valuation method. So you're not going to be restricted if you're filing a consolidated return. You don't have to conform your inventory methods. One can use LIFO, the other use FIFO, that's fine. So, okay, so there's three circumstances in which you get a sort of different answer. Actually, letter C, it's not different at all. The other two, you do get a sort of a different answer, but the bottom line result is effectively the same. So kind of a silly question, but there it was. All right. Eligibility. How do we know if we can consolidate? An affiliated group of corporations may elect to file a consolidated return. In most cases, we'll see in some exceptions to that in a little bit. But the first condition is you must have this thing called an affiliated group. Affiliated group consists of a parent corporation that owns 80% or more of the stock of other group members. So here's parent corporation P. Subsidiary corporation S, and P owns 80% of the stock of S. That's an affiliated group. looks like P and S can elect to file consolidated returns. Affiliated group also includes any corporation that is owned 80% or more by other corporations in the group. So P owns 80% of S, and S owns 80% of T. P, S, and T are all part of the affiliated group. Also, look at this. P owns 80% of S and 80% of T, and then S and T own a total of 80% of Z. S owns 30% of Z, T owns 50% of Z, and 20% of the Z stock is owned by outsiders. That also is an affiliated group because Z is owned 80% or more by other corporations in the group. None of it is owned by P, but S and T together make up 80%, and S and T are each 80% owned by P. So those four corporations are in an affiliated group. This is not an affiliated group. I didn't choose P, S, and T anymore because there is no actual parent in this group. Take a look at it. We just have A, B, and C. A owns 60% of B. A also owns 30% of C. B owns the other 70% of C. And C owns the other 40% of B. So B and C are owned 100% by A or each other. But the problem is, even though B and C are 100% owned by others in the group, there is no corporation that owns 80% or more of another corporation. So it looks like maybe it ought to be an affiliated group, but no, it really isn't. So therefore, A, B, and C cannot file consolidated returns unless they straighten out their stock ownership a little bit. The managers of A, B, and C could all sit down and figure out how to do that. It wouldn't take very long. But right now, they cannot file a consolidated return. Ineligible corporations, even if you're in an affiliated group, you can't file a consolidated return, or at least you cannot be part of a consolidated return if one of these conditions applies. First of all, you're a non-U.S. corporation. So if you have an 80% owned subsidiary incorporated in France, nope, sorry, cannot file a consolidated U.S. return. Tax-exempt corporation. Why you would want to bring a tax-exempt corporation into a consolidated tax return, I'm not sure. But if you want to, you can't. So don't even think about trying to come up with a reason to do it. Can't do it. Insurance companies. Insurance has its own separate section of the tax law. And I have to admit, I don't know anything about corporate tax law for insurance companies other than insurance companies are different from all other corporations. And an insurance company cannot be part of a consolidated return. Also, any non-corporate entities like partnerships, LLCs, estates, trusts, none of those can be part of a consolidated return. So let's suppose we have parent company P with 100% owned subsidiary R, and R owns 90% of S, and also 100% of T, but T is an insurance company. Well, in that case, P, R, S, and T are an affiliated group. They meet the definition of an affiliated group, but T cannot be part of the consolidated return because it's an insurance company. P, R, and S can still elect to file a consolidated return. They just have to leave T out. T is ineligible because of what it does. It's an insurance company. What if you have P owning 100% of R owns 100% of T, the insurance company, and T owns 90% of S? Now, T and S cannot be part of the consolidated return. T because it's an insurance company, S because it's owned only by T. So it's only in the affiliated group because T owns a part of it. So P and R can consolidate if they want. T and S cannot. And they can't consolidate with each other either because T is an insurance company, not allowed to do any consolidations. So S is going to have to file a separate return. Next, you got to make the consolidation election. So that is part of the process of electing to consolidate. You meet the conditions of an affiliated group, and then you decide, yes, we're going to do it. To make the consolidated election, first, the subsidiary has to conform a tax year to the parent's tax year. So suppose the parent's last separate tax return year was January 1 to December 31, the regular calendar year, that even corporations, which are not required to be calendar year entities, most corporations are actually December 31st year end. Most individuals, virtually all individuals are, but it's a lot more convenient for individuals to be calendar year taxpayers. Corporations, there's a lot of corporations with non-calendar tax years. But again, the majority are still December 31st. So let's suppose that the parent's last separate tax return year is a calendar year. But the subsidiary's last separate tax return year is October 1 to September 30th. Now, if it's going to consolidate in 2025, then the first consolidated year will include P for the full calendar year 2025 and S for the short year, October 1 to December 31. So you got to conform your tax year to the parent's tax year, which means conform to their year end in that first year. The year beginning will be based on whatever your last separate tax return year end was. But your year end has to agree with the parent's year end. And of course, from then on, you're a calendar year corporation. So that's the first thing. Conform your tax year to the parent's tax year, and then file the consolidated return by the due date. If it's a December 31st year end, that's going to be April 15th. And include Form 1122 for each subsidiary. 1122 is a very simple form. Looks like this. I've also uploaded it onto Brightspace so you can look at it separately, but it's very simple. Just says, who are you and who's in charge here, and do you agree to be consolidated? That's pretty much it. Years following the first consolidated year, we have to include the affiliation schedule in the consolidated tax return. That is Form 851. That is also uploaded onto Brightspace. It looks like this, but it's much longer. This is just the top. You can look at the entire form. I will upload that as well onto Brightspace, so you'll be able to check out the whole form, and the instructions are also included in the form, so you can look at the whole thing. Tax sharing methods. Now, these are the methods for figuring out who owes the tax. It's a consolidated tax return. There is one tax. This is the amount of tax that the consolidated affiliated group owes. Each member is legally, jointly, and severally liable for the total consolidated tax. So, in that sense, everybody owes all of the tax. But for things like computing earnings and profits, you have to allocate among the members of the group. Earnings and profits is the only reason I can think of. That certainly is an important one. What's my earnings and profits? Well, subtract out your share of the tax. I have to figure out what my share of the tax is before I can do that. There may be other reasons. E&P was the one that I was able to think of, and I couldn't come up with any others, but certainly E&P is an important choice. So how are we going to do this allocation? Methods include equal. That is actually the default. If you don't adopt a different method, then just, if there's 3 members in the group, take the total tax, divide by 3, each one gets a third. That's probably not the sensible way to do it. You can imagine a very large parent with a very small subsidiary. You really want to divide those up 50-50? Probably not. So you might base it on relative taxable income. That's a sensible way to do it. Or on relative tax liability. If you do it on either of those two, you will be doing a method that has been accepted by the IRS and is also fairly popular. I don't know how popular equal is. Wouldn't be very popular with me, but I don't know how many corporations actually use it. Let's take a look at problem number 32. The Chief Consolidated Group reports the following results for the tax current year. Dollar amounts are listed in millions. We have a parent, sub 1, sub 2, sub 3, and consolidated. The taxable income for the parent is $850, for sub 1, $200, for sub 2, $150, and for sub 3, $0. Sub 3 actually has a loss. So that is a total taxable income of $1,200. The allocation ratio, if you're basing it on taxable income, is going to be fraction of 1,200. So 850 out of 1,200, or 200 out of 1,200, or 150 out of 1,200, or 0. So the tax liability then, now the tax liability for the entire group is $208. That loss that is not deductible entirely by sub 3 can be fully absorbed by the consolidated group. And there's also an energy credit that sub 1 has of $20 million. And so therefore the total tax is the total tax liability is $228, and then subtract out that energy credit of 20, and you get a net tax of $208. So the tax liability, $147, that's just $208 times 850 divided by 1,200. For sub 1, $35, $208 times 200 divided by 1,200. And sub 2, $208 times 150 divided by 1,200 is $26 million. And 0 for sub 3. 0 times whatever is divided by 1,200 is 0. Okay. So there's your 208, your $208 million tax liability. Now, problem 33 says same thing, except we're going to use the relative tax liability method. So that's 33. Here's the 4 corporations tax liability, $178.5 million. That is just based on the $850 million separate taxable income. Sub 1, it's $22 million. That is 21% of 200 minus the $20 million energy tax credit. So 42 million is 21% of 200 minus the $20 million credit is 22. There you go, net of energy tax credit. And then sub 2, 150 times 21% is 31.5. Sub 3, of course, 0 tax times 21% is 0. Okay, so that's 232 million if you just add those up. Now, of course, we know that the total tax is 208. That's because sub 3's losses have not been factored into calculating the separate tax liabilities of parent sub 1 and sub 2. Allocation ratio then is going to be based on what fraction of 232 million do you have? 178.5 over 232. Take your $208 million tax liability times 178.5 divided by 232. A bit of rounding there, and you get 160 million. 208 times 22 divided by 232 is 20. 31.5 times 208 divided by 232 is 28. And of course, 0 is 0, and there's your 208. So you get the same $208 million tax liability divided up very differently. Mainly, the big change is sub 1 has a much lower tax liability because they're the ones who generated that energy tax credit. If you base it on taxable income, you don't take into account the energy credit. If you base it on relative tax liability, you do. So your choice of which method you want to use may depend on how many different credits your different corporations are generating. And that is it for our first video, just talking about how to qualify as an affiliated group and elect the consolidated return.